We talk a lot about what the landing will look like. We rarely talk about what the liftoff after that landing looks like. So if we're in this environment, we get this soft landing. How important is it that growth isn't anemic, that it can take off again for a more sustained and longer term rally?
So it is really important, but actually I'm going to say something slightly different. So when I think about the landing, we think that fine, you can get a soft landing up to Q1 and Q2 next year. But to the point that the Fed starts to cut, the people who are waiting on the sidelines to buy a property, and if you don't have job losses, I worry about how does the economy react to that? You could see another takeoff and then another acceleration. So actually, I think, to me, although I know that's not what people are necessarily talking about, although the acceleration is not key at the moment, maybe as you look to 2025, that is a theme that starts to return to the market.
No, I think that's such an excellent point, Seema, because it raises this question, is the Fed going to have the opposite intended fact when they start to cut? That everyone rushes to the market and all of a sudden housing prices go up, and how policy is usually transmission isn't transmission the way it is. So does that mean if the Fed starts cutting, they need to start cutting aggressively in order to make sure that it is not a housing market that takes off like crazy, that there's some incentive for supply to come back in?
I think they just actually be really careful how they cut. I mean, I do believe that they need to have all of the evidence in hand before they start those rate cuts. They need to be very clear that there is a softening in the economy. They need to see that the labour market is maybe not showing clear cracks, but there is a rebalancing taking place. Otherwise, they risk almost disrupting the economy again, and then we've been back to the same place as we were a few years ago in about 12 months of time.
When it comes to the housing market, though, potentially those individuals that maybe they've wanted to upgrade to more space, but they're sitting on a 3% mortgage. What if all those people come into the market and then actually you have so much supply that it dilutes pricing power? Wouldn't that be almost a Goldilocks for the Fed?
It would be, but actually, I think although the supply has increased, the amount of people who are waiting on those islands, as you said, have been enjoying those 3% mortgage rates, but scared to go to buy a new property. Once they come back flooding into the market, I actually don't think that the supply is sufficient to stop the housing market from taking off again. So I think that that is one thing that the Fed really needs to keep a very close eye on in order to avoid this second wave of inflation, which, look, at the moment there is absolutely really no sign of. But I think it is a risk that the Fed is very aware of, which is one of the reasons why they are so careful about the timing of those cuts.
You talk about history suggests that long Fed pauses are good for stocks. But when you look back at history and in your research, has it always been this concentrated? I mean, I look at Peter Cheer's note today, which is kind of how you started the show. Fragility in a one stock is a stock market. It's all about Nvidia. Have we ever seen anything like that?
I don't think we've seen anything quite like this in a way that the tech gains are quite fundamental. I mean, there's something fundamentally driving it. I wouldn't compare it to the dot-com. But also when I look across at tech, I think they're somewhat macro agnostic. I don't think they're necessarily reliant on what's happening in the macro space. I don't think they're necessarily reliant on the Fed space. I think they actually create their own demand. At some point, that party will stop. It doesn't look like it's any time soon, but at some point it will stop. That, I think, is a very hard part to predict.
So you sound kind of bearish. What are you doing?
If I sound bearish, I don't mean to. I think that we should actually be slightly risk-on, but not as risk-on as we were about 6 months ago. So we do have a slight overweight to equities, but that has been pulled back a little bit because, as I said, we think that the equity gains are quite limited from here when you start to see that slight softening in the economic backdrop. And when there is so much concentration, that sentiment is starting to get a little bit impacted, where people are getting a bit worried about how much exposure they have to these very, very high, these high stocks. Within fixed income, we actually think it should be back to neutral. Investment grade is probably the area that you want to be focused on with slightly high quality, but duration doesn't look very attractive to us. At 425, especially as you were talking before about the fiscal deficit, I don't see yields coming back down too far because that term premium is going to keep thinking about the deficit.